Did you know the key to a comfortable retirement might be the invisible power of compound interest? Imagine watching your money grow non-stop over the years, working for you while you focus on the present. In this video, we'll show you how investing wisely in accounts like 401ks and IRAs can transform your financial future and ensure a worry-free retirement. It's never too late to start, and compound interest can be your greatest ally in achieving financial independence. Stick with me, and let's find out how. Have you ever imagined your money growing on its own without you needing to work more hours or risk big investments? That's possible thanks to the power of compound interest, and it could be the key to ensuring a comfortable retirement. In today's video, we're going to uncover how you can use this invisible force to your advantage, investing wisely in retirement accounts like 401ks and IRAs, so your money keeps working for you for years to come. The best part is it doesn't matter how much you earn or how much you can invest initially. The secret is to start early and make regular contributions, taking full advantage of the exponential growth of compound interest. We'll show you how small adjustments to your contributions can generate big returns over time, creating a solid foundation for your financial future. It's not about making big bets or hoping for a miracle solution. It's about being consistent and smart with your financial choices. With compound interest, time is your greatest ally. You can turn small amounts into a fortune over decades simply by understanding how the compounding effect works in retirement accounts. So, if you want to ensure a future without financial worries, it's time to take control and start using compound interest to your advantage. In today's video, we'll guide you every step of the way to maximize your savings and ensure your money works for you until retirement. In a scenario of rising inflation where the value of money decreases over time, understanding the power of compound interest becomes essential to preserving the purchasing power of your retirement. Inflation can erode the value of what you save today, making it difficult to maintain the same desired lifestyle in the future. However, by investing smartly and taking advantage of the effect of compound interest, you can keep your retirement balance growing, overcoming the loss of purchasing power caused by inflation. Compound interest works like a multiplication tool, making your money work for you and accelerating growth as time passes. If you choose the right investments that grow faster than inflation, compound interest will amplify your returns, helping to ensure your retirement has the same purchasing power you expect regardless of inflation. Starting to invest early and making regular contributions is key. The sooner you put your money to work, the more it grows. Each year, compound interest increases the value of your investments, creating a financial snowball that, over 10, 20, or 30 years, completely offsets the pressure of inflation. This allows your wealth to grow robustly and preserve its purchasing power during retirement. The type of investment you choose also has a big impact. Stocks, real estate, and other growth assets are essential because they outperform inflation over time. Even if the nominal value of your money is affected by inflation, the returns from your investment portfolio have the potential to grow more than inflation itself, offering solid protection against price increases over the years. Compound interest causes your earnings to accumulate not only on the invested amount, but also on the accumulated interest, creating an exponential effect. This means that as time passes, the amount of money accumulated grows at an accelerated rate, overcoming any negative impact that inflation has on purchasing power. The secret is to let your investments grow naturally without rushing, allowing compound interest to work for you. It's important to remember that consistency in contributions is the key factor in maximizing this effect. When you invest automatically, as in the case of retirement accounts, the compounding effect intensifies, and you don't waste time trying to time the market. Your investments continue to grow continuously, even in times of economic uncertainty, ensuring a more secure financial future. Over time, you'll realize that a long-term strategy is the most effective. Investing regularly, making smart financial choices, and allowing compound interest to do its job creates a scenario where the growth of your wealth outperforms external forces like inflation. When we talk about retirement investing, many don't realize how much investor psychology can influence the success or failure of their financial choices. Fear, anxiety, and impulsive decisions can undermine the power of compound interest. The simple act of making decisions based on short-term instinct, like panic selling when the market is down, can significantly affect the growth of your portfolio and prevent compound interest from playing its crucial role in the long run. Investing with a long-term mindset is one of the most effective ways to take advantage of the multiplying effect of compound interest. When you resist the temptation to sell quickly during moments of market volatility, your investment remains intact, allowing it to continue growing as interest is applied. This creates a scenario where, instead of being affected by market fluctuations, you are taking advantage of the continuous growth of your portfolio. By maintaining a disciplined approach, you allow compound interest to do its job without interruptions. Each time you hold your investments, interest accumulates on the interest, increasing the value over time. This is something that cannot be achieved by quick changes or hasty decisions. Stability and patience become great allies, giving space for compound interest to make a continuous accumulation of wealth. Fear is one of the strongest emotions that affects investors. Worry about losses in the market can lead to quick decisions, like selling assets during a decline. However, by understanding that compound interest gains strength over time, even moments of temporary market downturn are not the end for your investments. Compound interest continues to work, regardless of short-term oscillation, and your patience can generate results later. Another important point is the anxiety related to quick returns. The expectation of immediate results can lead to frustration and impulsive actions. However, by understanding what really matters, constant growth over time, you adjust your perspective, recognizing that the value of compound interest increases gradually, not explosively and instantaneously. Solid and regular investments create the ideal environment for the growth of your savings. Investors who maintain realistic expectations are more likely to take advantage of the effect of compound interest. Instead of waiting for quick or miraculous returns, it is crucial to adopt an approach that allows for continuous and disciplined construction. The impact of compound interest is visible over time, and with small regular contributions, gains accumulate exponentially, strengthening your portfolio over time. Investing with automation can be a powerful psychological tool. Setting up automatic contributions to retirement accounts eliminates the risk of emotional decisions. Automation not only removes the aspect of decision-making, but also ensures that you take advantage of compound interest continuously without having to worry about market timing. With this, you allow your money to grow consistently and without external interference. The real key to taking advantage of compound interest is to maintain focus and discipline during the investment process. Avoiding emotional reactions and maintaining a consistent strategy can be more impactful than any impulsive movement. As you focus on discipline and a long-term vision, the power of compound interest works to strengthen your savings and ensure a more secure financial future. Investing consistently is one of the biggest challenges investors face, especially when daily life demands so much of our attention. However, with investment automation, you can ensure that your retirement contributions are made regularly, regardless of your schedule or financial situation at the moment. By setting up automatic investments, you eliminate the temptation to procrastinate or make decisions influenced by emotions, creating a disciplined approach that takes full advantage of compound interest. When you establish automatic contributions, your money starts growing from the moment it is deposited, without the need for constant action on your part. The most powerful thing about this is that your money starts working for you immediately. This means that the effect of compound interest starts to happen faster and without interruptions, resulting in continuous and accelerated growth of your investments over time. Another benefit of automating investments is that you don't have to worry about market timing. Many people hesitate to invest due to market volatility, trying to guess the best time to enter. By automating your contributions to accounts like 401ks or IRAs, you take advantage of dollar-cost averaging, where money is invested regularly regardless of the price of the shares at the moment. This helps reduce the risk of buying at unfavorable times and maximizes growth opportunities. The consistency of automatic contributions allows you to benefit from the multiplying effect of compound interest, which is only possible when you regularly reinvest your earnings. Instead of withdrawing or spending your earnings by setting up automatic investment, you leave the accumulated capital in the fund, allowing it to grow exponentially over the years. Each new contribution added to the growth of interest increases the total balance in an accelerated way. With automatic investment, you also avoid the negative impact of investor emotions. Fear during moments of market volatility can lead you to sell assets at the wrong time, harming the growth potential of compound interest. But when contributions are made regularly and automatically, you create a rational and less error-prone approach, allowing compound interest to do its job without emotional interruptions. Automation not only improves discipline in the investment process, but also ensures that you don't miss growth opportunities. Even in periods of financial difficulty, by setting up a fixed amount to be invested regularly, you put yourself on the right path to ensure a secure retirement. This means you are creating a healthy financial habit that results in a growing retirement balance, even without major daily sacrifices. Investing automatically also offers a clearer view of your finances. By knowing exactly how much will be invested every month, you can better plan other parts of your budget. This clarity brings security and control, allowing you to focus on your other financial priorities without worrying about actively managing the investment process. In addition, many automatic investment platforms offer low management fees, which means you can take advantage of compound interest without worrying about high costs that reduce your profits. By opting for automatic investments in retirement accounts, you access the advantages of a low-cost investment that continues to grow without being eroded by high fees. It's important to remember that when establishing automatic investments, it's not necessary to start with large amounts. Many people believe they need a fortune to start, but the key is to start with what you can and adjust your contributions over time. Small adjustments over time can result in large accumulated sums, and this is one of the greatest benefits of the effect of compound interest. Over time, by automating your contributions and allowing compound interest to do its job, you will see how your investments grow more efficiently. The magic of automation is that it allows you to invest consistently and at the same time take advantage of the power of compound interest to ensure that your retirement is built on consistency and exponential growth. The cryptocurrency market has been gaining global attention, and at the same time, many platforms have started offering compound interest on crypto investments, which can be an interesting alternative for those looking to diversify their retirement. Although cryptocurrencies still carry significant risks, they also present a much greater growth potential than traditional assets due to their volatility and the potential for high valuations over time. The idea of applying the power of compound interest to the world of cryptocurrencies can be an effective way to increase your wealth in the long term if done strategically. Cryptocurrency staking platforms allow you to lock your coins into long-term contracts, which generates compound interest on your investment. This process allows you to earn more cryptocurrencies over time simply by keeping your coins in circulation. The concept of staking works similarly to earning compound interest in bank accounts or traditional investments, but offers the advantage of potentially higher returns given the explosive growth nature of some cryptocurrencies. For those looking to strategically enter the crypto market, investing in stablecoins can also be an option. These coins, typically pegged to the value of fiat currencies like the US dollar, offer a more stable option within the volatile cryptocurrency ecosystem. By investing stablecoins on platforms that offer compound interest, you can create a steady stream of passive income, protected by a more stable digital currency, allowing your retirement balance to benefit from high interest rates and capital preservation. However, the cryptocurrency market is not without risks. Extreme volatility can cause significant losses in short periods. Therefore, it's essential that anyone who chooses to use crypto as part of their retirement strategy does so with a controlled portion of their portfolio, never allowing crypto investments to exceed an amount that could compromise their future. Financial security. The key here is smart diversification, balancing cryptocurrencies with more traditional investments to create a solid portfolio. Even with the risks, cryptocurrencies have a unique potential for appreciation that other assets cannot offer. When applied correctly, compound interest in crypto can multiply your investment significantly over time, especially if you're willing to maintain a long-term view. When investing in crypto, the goal isn't just to seek quick gains, but to take advantage of the compounding effect, which can be extremely advantageous given time and patience. For those who are new to crypto, starting with more conservative investments, such as cryptocurrencies with a larger market capitalization, can be a safer approach. Coins like Bitcoin and Ethereum, for example, have been more resilient in the market, and investing in them through compound interest platforms offers an opportunity to grow capital more safely while taking advantage of the benefits of compounding. Furthermore, cryptocurrencies transcend geographical boundaries, allowing you to invest in a global market without the limitations of traditional markets. This global aspect can be advantageous as it allows your retirement portfolio to benefit from opportunities in different economies while being able to withstand the inflation of a single national currency. Access to a variety of cryptos allows you to diversify strategically and maximize the effect of compound interest across different assets. However, for those who wish to invest in cryptocurrencies as part of their retirement, continuous education is crucial. The crypto market evolves rapidly, and the best strategies for maximizing compound interest can change over time. Constant monitoring and adaptation to new market trends will be essential to ensure your investments grow safely and sustainably, while taking advantage of the innovation of cryptocurrencies in the financial world. One of the most powerful ways to use compound interest in your favor is to understand how to adjust your contributions to retirement accounts like 401ks and IRAs. How you contribute over time can profoundly impact the growth of your retirement fund. Many people don't realize that even small changes in contribution amounts made consistently can result in significant differences in the final amount over the years due to the compounding effect. To maximize the power of compound interest, gradually increasing your contributions is an effective strategy. As your financial life improves and your income increases, you should adjust your contributions to keep pace with that growth. If you start with a modest contribution but increase it over time, the effect of compound interest will have more time to work on a growing amount, amplifying the growth of your retirement. In addition, when considering adjusting contributions, it's important not only to increase the amount in absolute terms, but also to adjust the percentage of your salary allocated to retirement. Many 401k plans offer an employer match, which means you can get free money simply by contributing up to the limit offered by the company. Taking full advantage of this match is a way to increase the value of your retirement without having to increase your personal financial burden. Another important aspect is to consider diversifying contributions among different types of investments within the 401k or IRA. As you increase your contributions, Keep in mind that a diversified portfolio can enhance compound interest, allowing different types of assets, such as stocks, bonds, and mutual funds, to generate returns together. Diversification helps mitigate risks while maximizing returns over time. Automating contributions is also an excellent way to ensure you're making the most of compound interest. If you set up your contributions to be made automatically, it ensures that the money is invested consistently, without the need to remember to make each deposit. The effect of compound interest is amplified when money is invested regularly over many years, without interruption. As you increase your contributions, it's also important to periodically review your financial goals and adjust your retirement targets as your situation changes. What you define as a retirement goal can evolve over time, and your financial contributions should reflect this. Reevaluating your contributions as your income increases or your goals change can ensure you're on track to achieve the retirement you want without having to worry about last-minute adjustments. If you're in a retirement plan with contribution limits, such as a 401k or IRA, it's important to maximize those contributions within the allowed limits. Be sure to take full advantage of these plans before seeking other investment options. Contributing the maximum allowed not only increases your retirement balance, but also allows you to minimize your tax burden, as contributions to these plans are often deducted from income tax. When adjusting your contributions to a 401k or IRA, keep in mind that the ultimate goal is always to create a secure and growing source of income for your retirement. The sooner you start adjusting your contributions and harnessing the power of compound interest, the stronger the growth of your fund will be. By doing so strategically and disciplined, you ensure that as you approach retirement, you'll have a solid financial foundation capable of sustaining a comfortable lifestyle. You may have noticed that building a solid retirement doesn't depend solely on luck or large initial investments, but rather on consistent, long-term decisions. The truth is, by understanding how compound interest works and how you can use it to your advantage, you're already taking the first step towards ensuring a more secure financial future. The effect of small adjustments over time is more powerful than many people imagine, and that's what can really make a difference over the years. Now imagine how you'll feel when you realize you're in control of your financial future. You don't need to be a finance expert or have large initial amounts. The simple act of making more informed and disciplined financial decisions can have a significant impact, not only on your investments, but on your confidence. Financial security comes from small actions repeated, and the key is knowing where to invest and how to make your money work for you. The psychology of an investor is often underestimated, but as we've seen, emotions can be a major obstacle or a great ally in the wealth-building process. The secret is not to let fear or anxiety dictate your decisions, but to understand that time and patience are the greatest allies when it comes to compound interest. By investing with a clear and long-term vision, you create a path where results emerge naturally and progressively. The good news is that by incorporating the concept of compound interest into your financial life, you're maximizing your chances of achieving your goals. The difference lies in the mindset. Those who understand how the system works and follow simple, consistent strategies end up positioning themselves much better in the future. It's a journey of constant learning where each small action can bring exponential returns when well executed. So as you look to the future, don't focus on what you don't have now, but on what you're building with each financial decision you make today. Over time, the fruits of this labor will begin to manifest, and your confidence in your ability to achieve your goals will be strengthened. If you're ready to put these concepts into practice and ensure a secure financial future, be sure to subscribe to the channel, turn on notifications so you don't miss any of our videos on how to use the power of compound interest, invest intelligently, and transform your retirement. Leave your like, share with those you know who can benefit, from these tips and start building a better financial future today.